Good afternoon and welcome to the summer 2024 Linneman Associates Capital Markets webinar presented by Linneman Associates and Real Estate Financial Modeling. This is your host, Bruce Kirsch, founder and CEO of REFM, provider of financial analysis tools and training to the CRE business since 2009. We're pleased to have an insightful program for you today, which will be presented by Dr. Peter Linneman, founder of Linneman Associates, which, for those of you who do not know, is a strategic and investment analysis advisory firm. We're using Zoom, and I'll just go over a couple of housekeeping items to make sure everyone's comfortable. On the audio front, all of the participant audio, meaning your audio, is muted, meaning we cannot hear you, and that's by design, and that's going to remain the case through the webinar. If you're on computer, take a moment to familiarize yourself or reacquaint yourself with the control panel elements. We will be showing the slides in the broadcast window, but if you would like to download them, we have put them in the chat and we'll put them in again as we get underway. You don't need to have the slides up because we'll be showing them, but you're certainly welcome to keep them for future reference. And as always, we've reserved 15 to 20 minutes at the end to answer participant questions. Feel free, however, to submit your questions at any time by clicking on the Q&A button, typing the question in, and make sure to click send to send it through to our side. If you get disconnected, just reconnect how you did initially. And if you're registered later today, you will receive an email with the link to the recording. And the video will also be posted on the Linneman Associates website later today. Without any further ado, I'd like to introduce today's presenter, and always the presenter, Dr. Peter Linneman, CEO of Linneman Associates. Peter, how are you doing as we round the corner into fall here?
Well, it's a gorgeous day here in Philadelphia. I'm back from my annual visit to Kenya for the charity, which was quite amazing. And also went to Poland and Lithuania on the way back. So I'm back in the real world and like all of you, grinding away a bit. Bruce, I think it's worth mentioning that we're going to do, instead of 3 months from now, which is sort of the normal rhythm of our sessions, we're going to do it. Our next session will be November 7th, which is 2 days after the election. And we thought that would be a useful timing to have while people are thinking about it, but also we know a little bit on the outcome on the political front. We'll do the format we did a while ago, which is more of a question and answer session than a presentation session. We'll cover all the topics and then some. Bruce will sort of lead the way, and we'll send out ahead of time any of you who have particular questions you'd like addressed. It gives us more time to get to them rather than trying to jam them in at the end of a regular presentation. So we'll do a little change of pace. If we go to the first slide, it asks the question everybody asks, and is the economy slowing? And the answer is, of course. And the reason, there are two reasons, but the main reason it's slowing is because it was going quite rapidly for the last few years, simply recovering from the deepest lows since the Great Depression. And so we forget what life was like just 4 years ago. You still had 4 years ago, everybody's wearing masks, no one is traveling, you couldn't go to Europe, I couldn't go to Africa, no one could go to the ball games, et cetera, et cetera. So of course, every day that's gone by and we've recovered from that unprecedented, we get closer to normal. As we get closer to normal, we get more normal growth. And more normal growth is lower than the extraordinary growth coming back from a downturn. I think that's important to understand. So for example, the job openings have fallen quite dramatically. Thank goodness the job openings have fallen quite dramatically, because it shows a normalization of the labor market. And in fact, the job openings that currently exist are around what you'd expect in a normal economy that's growing. And I just use that as one example. So don't be fooled. Normal is where we want to be. It's a lot better than being overheated, and it's a lot better than being way below trying to catch up. We're back close to. Now, on top of that, the Fed is needlessly slowing about 20% of the economy. And in particular, it's slowing auto and housing. And it's very bizarre when you think about it, that the Fed is slowing housing production and consumption, which is the main pressure point in measured inflation. And you'd say, now wait, you're fighting inflation by reducing the supply of something that's massively undersupplied, and that's why prices are going up there. And it's completely crazy policy. And autos are also being slowed because about 2/3 of auto consumers borrow relatively short-term money, a lot of floating money. And in addition, businesses' profits are high but flat. And that's because the economy is growing, but high interest payments on lines of credit are chewing up that. So profits are kind of high but flat. Manufacturing, high but flat now for almost 2 years. And then the regional banks are suffering because you have a way too high interest rate, and we'll come back to that. The economy, though, is not quite normalized. It's recognizably normalized, but we still have gaps in real GDP, and we still have a gap in employment and many other things. One thing I point out to people, and this is not a mathematical certainty, this is an old man's observation. Recoveries generally last 6 to 8 years. You can find exceptions that are shorter. You can find exceptions that are longer. For example, the pre-COVID recovery was almost 10 years. And the reason is it generally takes 6 to 8 years of recovery for excesses and problems to build in an economy that cause a recession. I point out to you that we're only 3 years into a recovery. This is still a very young recovery. And I just think people lose sight of that. It's a young recovery, and we still aren't quite back to normal. So I don't see where there is a big risk of recession, even with a Fed that's kind of grossly bent on trying to cause a recession. Go to the next chart. I already mentioned it. Real GDP, anytime I mention real, just adjusted for headline inflation, still about 2.2% below trend. So the red line is where it was pre-COVID. The aqua line is what that simple trend from the 2010s would have had it at. And the dark blue is where we're at. You can see that, yeah, we've come a long way. We've made a great recovery. And in fact, you may remember people in the second and third quarter 4 years ago were saying, we'll never recover. No one's ever going to go back to work. No one's ever going to travel again. No one's ever going to do anything but shop online. It was almost like we were going to become the people in Wall-E and just drink sugary drinks and sit and do nothing. And of course, what we saw is people came back. The world kind of is the world. But we're still below potential GDP. And all I mean by potential is simple trend, the kind of things that drive an economy day in, day out. You go to the next chart, we're about 3.3 million. I don't want to put too fine a point on it, but we're still about 3 million, 1.5%, that's 2%. That's kind of consistent with where GDP is below. They kind of map, not surprisingly. And again, you say, oh yeah, employment growth has slowed versus 2 years ago, but thank God we're actually above where we were, but we're still below where we would generally be given our population growth, et cetera. So there's still room there for continued growth. If you go to the next chart, this is industries adding workers. I find it kind of interesting. 50% is the red line. So if it's above the red, more than 50% of SIC codes are adding. And you can see it's kind of normal where we're at now. We got way above normal in 21, 22, and early 23. That's because so much had been shut down that a whole bunch of sectors that would not normally be adding jobs had to add jobs because they were shut down. And now you're getting back to a more normalized situation. I point out to people that if you want a reminder of how strange this downturn was and was unlike any other downturn, and therefore modeling this recovery as a normal recovery, in a normal downturn, activity in Vegas might fall by 4 or 5% when GDP falls by 1.5%. Vegas was shut for about 9 or 10 months. I mean, it wasn't down 4 or 5%, it was shut. Orlando wasn't down 4 or 5%, which would have been normal in a normal downturn. It was shut. And that's what we're coming back. You have to remind yourself of that in interpreting. And the goal is to look to normalization. Go to the next chart. One thing that has not normalized is the labor force participation rate of people 65 and over. And if I put 60 and over, you get the same image. If I put 62 and over, there's nothing magic about 65 per se. What's happened was a group that was continuing to work ever more and to be involved in working ever longer into their lives basically checked out. A notable chunk of them checked out and have not come back to the labor force. Every other age group in the population, whether it's immigrants or non-immigrants, of all races, of all education levels, every other basic group has come back to have a labor force participation, basically in line with what it was pre-pandemic, except this older group. And this older group, some of them died, I guess, or got incapacitated with long COVID, or said, I don't need this, or I'm done, I'm not going to go back after being off work for 2 years and then come back again. This is the missing workers. And some of them are unskilled, some of them are highly skilled, but cuts across the board. Some of them are urban, some rural, some professional, some non-professional. But when you say, where are the missing workers in the previous chart, this is essentially the group. And it's a fairly productive group. Go to the next chart. I just remind you of why I said the Fed is only slowing about 20% of the economy with a particular focus on housing and auto. The reason, by the way, that Fed interest rates policy theoretically worked is in a manufacturing economy, housing and autos generally were overheated when we had high growth. And therefore, if you raise the interest rate on those, they got less heated and it normalized the economy. This was very different. We had a shortage of housing, not an excess. So cutting it back made things worse in terms of inflation, not better. And similarly with autos, you think about it, in 2020, we couldn't go out to buy them. Then when we could, we were afraid to go out. Just as we could go out, the supply chains didn't allow us to buy them. And then just as people started to buy them again, interest rates said, makes it too expensive. Crazy policy. But that's the interest rate sensitive sectors. What's not sensitive? Government. I mean, if we need school teachers, if we need policemen, firemen, whatever, all that activity, basically insensitive to the interest rate. That's about 35% of the economy. No interest rate sensitive. Medical care, about 18.5% of the economy. And I jokingly say, no one is saying, gee, I'm having a heart attack right now, but I'm not going to go to the doctor until Powell cuts the interest rates 2 or 3 times. It's not interest rate sensitive. Education. No one is saying today, I'm not sending my kid to school because I think the interest rate's too high. So that's absurd. Those are huge sectors. And then you add things like food and other staple items. some number like 80% of the economy is not sensitive to interest rates. That's a much higher percent than when I was born 73 years ago. And we were much more of a manufacturing economy, much less a service. Government was much smaller. Medical was a much smaller part of the economy. Education outlays were a much smaller part of the economy. So even over the course of my lifetime, we've become much less interest sensitive. But there are these sectors that are hurt. And go to the next. I've mentioned autos, and so, but one of them is development, real estate development, because all of you know most real estate development is funded using floating rate money. And as that interest rate has gone up, it's raised the cost, if you will, of capital notably, and therefore cut off a lot of development. That's going to show up by in 2025, 26, you're going to have a spike in apartment rents, for example. Yes, right now there's a surplus, not a big surplus, depends on the market, but you shut down development and come back 2 or 3 years later, you know you're going to get a spike. But I already mentioned autos, some credit card debt. Remember, probably at least half of all credit card debt is nothing more than convenience. You paid for your dinner last night. You didn't think of you were borrowing to pay for your dinner. You paid for your dinner last night with a credit card. You're going to pay it off in the 21-day grace period. It's not true borrowing, but it does get measured as debt. And that's the main reason why credit card debt has gone up over time. It's not so much the profligacy of the consumer, it's the convenience of using credit cards. So there are sectors, though, that are. Go to the chart that says housing starts and auto sales. They're weak. I've normalized these so I can put them both on the same chart. I've normalized them to 100 in 1976. And this picture tells a really quick story, which is the blue, which is housing starts, and the red, which is auto sales, pretty much line up over one another until 2010. And in 2010, they get a divorce. And auto recovers in 11, 12, 13, and so forth, and housing stays low. And when it does pick up, there's a big gap between them, and it's not really until into the pandemic that the red and the blue co-integrate again. They overlay one another again after a decade of not. My view is the reason housing didn't recover was that in spite of an economic recovery, the Fed artificially kept the interest rate on short term down around zero. That robbed grandma as a safe saver of income on her CDs and so forth. Grandma did not give the money that she could have or would have otherwise given to the grandkids as a down payment for a home, and that was a drag on the housing market. Grandma then died prematurely because of COVID, and there was an early inheritance, and you suddenly saw down payment capacity go up. Also in 2020 and early 21, when there was nothing to buy, people saved, which increased the ability to get down payment. So they've joined one another again. That's the good news. The blue and the red are basically coincident, more or less. The bad news is they're both too low. And they're both too low from a fundamental point of view because of the interest rate effect. And that will eliminate a lot of that gap. And in fact, most of the gap in GDP, that shortfall of 2%, is due to housing and auto under consumption over, in the case of housing, for the last decade, in the case of auto for the last 4 years. If we closed those two gaps and got them back to long-term normal, GDP would be caught up. But you're not going to get those back to normal as long as the interest rate is as high as it is. That's why the Fed is sitting in a very important position, more important than they realize. Go to the next, real quarterly sales through brick distribution mechanisms as best I can estimate. And the red line shows the pre-pandemic high. And you'll notice that there was a big drop during the early pandemic 4 years ago. You see the sawtooth down. And that's when people said, no one's ever going to shop in a store again. And I said, gee, as soon as you open up the stores, people are going to shop there again, which is exactly what they did. And you can see that real brick sales have been pretty flat for the last year, which means that nominal brick sales are rising at about the rate of inflation. But brick is a long way from dead, and about 5 out of every $6 sold, not including auto, are still sold through brick outlets. It's a little hard to perfectly measure, but it gives you a picture. You go to the next, as best as one can tell, this is the percent of total retail sales that are done by e-commerce. And you can see it spiked. Well, it spiked when you couldn't shop in a shopping center. As you could shop in a shopping center, the percent went back down. And again, you see a normalization reverting to trend. And I put the red line in, not like it is the trend, but your eye would do that whether I put it in or not. So I simply put in the historic trend since 2009. But what you can see is it's starting to go up again because of some of the intrinsic advantages of what can be done online. Go to the next. I always find this interesting, how badly people understand oil. So this is the real West Texas crude oil price. And the aqua lines mark the high and lows in real terms on a monthly basis. Actually, the lowest occurred in early April 2020 when it was negative briefly. That is, you actually had to pay somebody to take oil off your hands. Now, that wasn't true over the course of a month, but it was down to $20 by a barrel at that point. And the high was back around 2008 at 180, and that's when people were saying, oh, it's going to be a $250. And you say, no, it's not. The extraction cost via fracking are break-even points around $40 to $45. If the break-even on fracking is $40 to $45, and there's a lot of it available, there's a fundamental ceiling that's put on. You get temporary aberrations from geopolitical and OPEC, but the fundamental is dramatic. And the interesting thing is the red line is the average since 1969 adjusted for inflation. We're very close to average right now. It's not like it's high, it's not like it's low. It's very volatile, but it's not like it's particularly high, not like it's particularly low. The economy functions pretty well with oil price. Remember, the big change is we're a net exporter of oil. We're energy independent. That is to say, by the way, we're the largest producer of petroleum products in the world. We're the largest exporter of oil in the world. Not Saudi Arabia, not Russia. We are. That wasn't true 12 years ago. A rise in oil prices does not help everybody in the US economy, but it helps the US economy. And that's because the people who benefit from high oil prices gain more than the rest of us lose. But net, we gain from high oil prices. And one of the things that the Ukraine situation has done has been net good for the US economy. I talked about that when the war broke out, that the US economy actually would benefit from the Ukrainian situation because of the energy, particularly natural gas, but also oil. Secondly, agricultural products. They were both big agricultural exporters and were good at it. And third is military equipment. And we're the largest producer of military equipment in the world. And so those actually have boosted our economy. It's tragic, but true, that an unstable world has boosted our economy. It's not our fault. It just happens to be in our wheelhouse. So oil prices, every time you hear somebody say they're going to go to $12, just stop reading the article. And every time somebody says it's going to go to $180, stop reading the article. It'd be a very temporary thing. If you're an oil trader, keep reading. But if you're a fundamental person, it doesn't matter. Go to the next chart. This is why we had inflation. This is the Federal Reserve of New York has put this together, and it's basically, think about it, if I go all across the economy, is there an excess demand for stuff or an excess supply? If it's below the line, a zero, there's an excess supply. If it's above the line zero, there's an excess demand. Not in every industry, but you can imagine if I went out and I told you, go out and measure a whole bunch of industries and average them up. Do we have more with excess demand or excess supply? Okay, and that's what they're doing. And then the point is, how big is it excess? And they measure it in standard deviations. And the simplest way to say it is almost all the time, the economy as a whole is within plus or minus one standard deviation of balanced, which is to say pretty much up to measurement error. The economy is balanced. And then suddenly we shut down the economy. That's the big area circled in red. And we got to 4 standard deviations of excess demand. What happens when you get an economy that has 4 standard deviations of excess demand? First of all, which has never happened, and has nothing to do with monetary policy. It had to do with logistical situations. It had to do with companies going out of business. It had to do with workers not coming back to work fast enough. When you get 4 standard deviation in an economy of excess demand, prices will rise. Now, the beautiful thing about our system, it's not perfect, and is that when you got that excess demand, prices rose very fast. And in fact, prices have risen in the economy about 20% over the last 3 years. Not 20% per annum, but over the last 3 years, just roughly 20%. Prices are up. By the way, including wages. Wages are up about 23%. So net, people are better off on average because they have 23% higher wages, 20% higher goods. You can certainly find people where they've not kept up, but you can find plenty of people have. And by the way, anyone on Social Security kept up with inflation plus. Anyone on welfare kept up with inflation plus. I'm just giving you examples of that. So don't let the newspaper article that says Mary Smith hasn't had a raise for 4 years. That may be, Mary didn't have a raise, but it's not indicative of the economy. Those high prices, that 20% increase, basically created profits, and profits bring about new supply. And what do you see happen to this excess demand? It disappears. And you can see that starting about a year and a half ago, we had swung from a position of excess demand massively to a bit of excess supply. Gee, what happened to prices in the economy? Independent of anything the Fed did, what you suddenly saw was inflation goes down. And the main source of inflation over the last year and a half, be above Fed target, is housing. And we'll come back to that. And remember what I said about choking off supply actually bids it up. So if you go to the next chart, this is annualized monthly inflation going back about a year and a half ago. And basically what you can see is if you take out owner equivalent rent from the indexes, CPI and PCE, we're down below 1% for several months. And in fact, even headline inflation, CPI, has not risen for 2 months. If you look at the CPI index, go look at what it was 2 months ago and look at what it is today, and you'll see it has not changed. Now, that doesn't mean no price has changed. It just means the basket has not changed. And if you annualize a zero increase over 2 months, it's a zero increase. And that's with mismeasurement of housing, which I'm about to talk about here in a second. So we actually are very possibly running a very small deflation if you actually adjust these indexes in a sensible way. So go to the chart that says inflation summary. So the inflation summary is over the last year, basically, we have 2.9% CPI inflation. By the way, it's about 2.1% for PCE, personal consumption expenditures. The main reason is it has a much lower weight for housing. It has just CPI has about a third of everything being whatever happens to housing price, and PCE has about 18%. So when housing is running a lot faster than everything else, CPI is higher. Okay, the annualized housing inflation over that period was 4.6%. Okay, back to my comment about the Fed and so forth. Annualized inflation over that period, that is year over year, is 1.8% without housing. And the main reason that housing is high is that they have owners paying rent about 5% higher than they were paying a year ago. Now, let me say that slowly. Those of you who are owners, are you paying 5% more in rent than a year ago? And you say, well, I don't pay anything in rent because when I own my home, what I own is the right not to pay rent. And 2/3 of all households are owners. So it's only a third of the households that rent. And they include rent for renters with about a 6 to 7 month lag for some strange reasons, but nonetheless. Over the last 30 years, net of housing, CPI has been 2.02%. It is running 1.8%. It's actually running a little lower than that because of the data that came out last week. If all you do is take out one item, owner equivalent rent, saying owners do not pay rent. That's simple. That's all you have to do. What you've got is over the last 2 months, it has been flat. That is, there's been no increase in CPI or PCE. And year over year, a 1.4% increase. So everything that's happening to headline inflation is all about housing and primarily due to this odd category, owner equivalent rent. So CPI attributes 24% of everything that a household buys to something that no one has ever bought. Okay, got the picture? And PCE attributes 12% to the same thing, which no one has ever purchased. And this is just obvious. And in fact, Europe occasionally gets things right relative to us. They do not include anything for owners in their price indexes. They do not include anything for owners. And the rationale is, and it's the correct rationale, yes, I track the increase in home prices because that's an asset. So I track stock prices, I track bond prices, I track gold prices, I track Bitcoin prices, it's corn prices. Those are assets. They're not consumer items in that regard. So I'm not saying you turn a blind eye to what's happening to home prices. What I'm saying is you don't conflate it in consumer expenditure inflation. And so they're very different. So the next chart is this CPI inflation, all items less shelter. And again, I show back to 1991. And what you'll see is we're back to normal. The last year on this chart to the far right is, if anything, slightly lower than all the things to its left, other than the explosion we just talked about during the shutdown. So the whole read of inflation has been crazy. Probably inflation for real, as experienced by real people paying for real things that they live on, is probably around 1.5% right now. Okay. And it depends. None of these indexes are right. They're all wrong. Just like what I just said is arbitrary. But for real, it's about 1.5%. The headline will say, yes, but the price of garbanzo beans is up 38%. Yes, you have 78,000 items. If you have 78,000 items that consumers could theoretically purchase, one of them is going to be up 38% in a year. All right. It's a small item. So it makes a great story, but it isn't the average. If you look at where Fed interest rates are at, they're just bizarre. Even if you take headline inflation with no adjustments for anything I said, if you take the average of consumer price index and PCE year over year, you come out with around 2.4%. If inflation is 2.4%, why do you have the short-term safe interest rate 300 basis points higher? That makes no sense from a capital market perspective, especially given the economy is slow and it's going to be below trend, and given that the sectors that are causing below trend are the most affected sectors in this interest rate sensitivity sense. You could easily have, if you have a 1.5%, 2% inflation rate, and you put 150 basis point premium, you get a 3.5% Fed funds rate, not a 5.25% to 5.5%. My friend Willie Walker and I talked about, 3-4 months ago, and I said, you're going to get 3 cuts at least this year. And of course, no one believed that at this time. And I think right now, 75 basis points is the consensus. Some saying 100. I think there's a chance of 100 because they've so misplayed it. And when the numbers started being more obvious, I sent Willie a note saying, with a photo of me picking out the shoes, because he said that if I was right, he'd kiss my feet. So I've got my shoes picked out for Willie. If you believe, though, as I believe, the inflation rate is probably closer to 1.5%, 150 basis points over that would have a Fed's fund rate at 3%. And 150 basis points is a big spread. If you said, what about 100 basis point spread? It should be 2.5%. If you say, I'm going to have the long rate 200 basis points above inflation, you should have around 3.5%. And 200 basis points is a little higher than the modern spread. And by modern, I mean once the Soviet Union collapsed and China joined the world in terms of creating wealth and created more demand for US government bonds. So people say, well, where do you think interest rates steady out? The short rate should come down to at least 3%. Not going to do it overnight because they are, look, this is just price fixing. They're not going to admit they were that wrong. So 3% is where the short rate should probably be right now. And the long rate should probably be around 3.4 to 3.5, heading down from there. Now, the next page, I'm just going to remind you, in Linneman letter is a template to try to work around what I just said, using your own views for the asset you're buying of where the long-term cap rate should be. And if I have a 2% inflation and I put 175 basis points spread over that for Treasury, and you put in kind of the normal risk premiums and such you talk about, for, let's take apartments because they're mark to market rents, I think you come out with a cap rate in the 4.3% range for apartments. Little lower if it's got higher growth potential, a little higher. If it's not as liquid, it'll be higher. If it's more liquid, it'll be lower. So I just remind you, there's a template there. There's a link to a template. You can play with it and see, but it gives you a basic framework. By the way, my research shows that cap rates are not very sensitive to interest rates. And the reason, think of the seabed, all right, at a particular GPS point. Well, obviously, if the seabed eroded, it would be higher to the top of the water. And if you got accumulation, it would be less height to get to the top of the water, right? So the seabed matters. I'm not trying to say the seabed doesn't matter. Interest rates matter. But what really determines the height of the water at a GPS point at any moment in time? Winds, storms, rains, tides. Swamp movements that occur in the seabed. So it's not that seabed doesn't matter to the ultimate height of the water above the seabed at any moment in time. It's just that they get swamped by the flows, the tides, et cetera. And I think that's the same way with interest rates. Interest rates, of course, matter, but they get swamped at any moment by the floods of money, the storm of money, the drought of money, the ebbs and flows of the tides of money in and out. And we've been in the tide is out for the last 18 to 20 months. One of the nice things is tides always come back in, storms of capital occur, and when it does, cap rates will fall. It's very simple. It's not about interest rates, it's about does money flow. And I think that's what you're going to see. Let me go to the next chart. I'm going to try to wrap up, Bruce. We still have a modest shortfall of multifamily housing nationally, maybe 350,000 on a 47 million unit base, so it's not huge. It is notable in a few submarkets. By and large, not terrible. If you go to single family, though, we have about a 3.5%. Again, roughly 100 million single family units, owner kind of focused units, single family units, and we've got a shortfall in supply of about 3.4%. That's for something people really want. This is not for bubble gum. If we had a 3.4% shortage of bubble gum, I don't think you'd see huge pressure on bubble gum prices. You'd see pressure, but there's a lot of other alternatives, candy and chewing gum and other things. Housing people really want, and we know that because we see how much of their income they'll spend in New York or in California or in Tokyo if they have to. It's not like people say, I'm going to spend 18% of my income. They will spend what they have to spend. We have a fundamental shortage. The Fed has made it even worse of single family housing. And that is why home prices rise faster than overall inflation. And that will continue until we start eliminating this. And I think it's almost impossible to eliminate this. Think about it, 3.4 million units. Imagine you walked into your community and you said, normally we produce 1,000,001 units, but this year we're going to do 4.5 million units so we can get rid of the shortfall. There's no way you'll get approvals. If you could make progress of 5 to 10% of that a year, that would be enormous progress. And yet over a decade, you'd still have a shortage. And so this is here to stay. Great news for apartments. Interestingly, it's good news for home builders in that they get the demand push from price, but their volumes are lower, right? So they would gain from volume, but they gain on the other hand from the home price. And then a real quick trip around the property sectors. Office vacancy rates up, probably stabilizing. Not the same everywhere. Interestingly, when you go to different places around the world, people are much more back than they are here. Yes, none of the places I know of are back as much as they were pre-COVID, but we are the world laggard in terms of being back. As labor markets adjust and normalize, I think you're going to see more people coming back to the office. My friend Jeff Blau, I think it was Jeff, if you're listening, once described the situation as Monday, about half the people are in, Tuesday, Wednesday, and Thursday, pretty normal. Friday's a national holiday. And that's not exactly accurate, but it kind of summarizes the situation. But it does appear to be showing some stabilization. Industrial vacancy rates are low. They've ticked up, particularly for more commodity space. So the CoStar numbers have picked up more than the Nate brief, which is a little more institutional. But by historic standards, they're still quite low. That's because the online sales is growing. As the online sales grows, they use a lot more storage space than traditional retail because of the handling and the wider aisles, et cetera. So this sector still has pretty good strength from a rent and occupancy point of view. Retail, almost no new retail has been built. You've had a box got torn down and got replaced, or a corner got improved. And yes, there was a little net growth, but you don't have a lot of growth in retail. And as the economy came back, good retail has done very well. It's hand-to-hand combat in retail, and that's because you're in the business of satisfying ever-changing consumer preferences. If you've got a good location, you know you're going to be the place where those preferences are going to be satisfied, but you just spent money getting in to the space, somebody who satisfied those preferences really well 4 years ago, but not so well today because of changing taste and purchasing patterns. Bad retail has always been bad retail. And then hotel occupancy has picked up. It's still below pre-pandemic. You still have also a bit lower supply. You still have a lot of pent-up demand for travel. If the airlines could ever get their acts together, and I say this having just traveled a lot the past month, any of you who traveled the last month, it's just absurd. I'll give you one little anecdote. A friend was trying to decide whether she would go a route that I was taking from Copenhagen to Newark or go through Frankfurt to get to Philadelphia. Anyway, she asked the agent in actually in Lithuania, are there any seats on the Newark flight? And said, completely sold out without checking anything. I get on that plane, and out of the 40 seats in business, 8 are empty. You're like, well, that was nice service, it's just crazy. But they're a main bottleneck. And then the last in multifamily, up in vacancy. It had, like everything else in the economy, it benefited from a shortfall, brought about a lot of supply. That supply has come online. That's pushed rents down temporarily. The high interest rates are now going to create a shortfall next year and the following year. It's up, but not awful, and things look decent. The very last chart, I guess, is a reminder. This is not meant to be political, because it seems like everybody in Washington just lives to spend your money. And if they can't get money from you to spend, then they'll borrow money from your future to spend. But these are 3 metrics of US government debt outstanding as a percent of GDP. So I've normalized by the size of the economy. The top is headline. The top is just headline. If you simply pick up how much federal government debt it says is outstanding, you get the blue line when you divide by GDP. and it's risen notably. If the second line, the reddish line, is take out any debt that any part of the federal government owns. Because if the federal government owes itself, that's intra-company debt, right? You could pay it off or not pay it off, it doesn't make a difference. So if you take out the intra-company debt, federal government owes debt to itself, you get the red line. Up, not nearly as high, not nearly as dramatic, more in the 60 to 70% of GDP range, which is a much more manageable number. And then the final one is, the lowest line is debt that US owes to foreigners outside of our system. And you can see, in fact, that's gone down over time. And the main reason federal debt went up so dramatically over the last 4 years was the Fed bought the debt. So a branch of the federal government, not technically a branch, but it is like a wholly owned subsidiary, bought the debt from the federal government. And so, yes, we spend crazily, but we can afford this. It's almost like Bill Gates can afford to spend stupid because he's got so many resources. But someone who has 10,000 a year income cannot afford to spend stupid. They don't have the resources. Zimbabwe cannot afford this kind of debt. They don't have those kind of resources to make those kind of stupid spending decisions. We do. And the most enjoyable part of federal spending is the creativity they use in coming up how to title what it is they're spending on. There should be a truth. If they were a business, they'd be sued by the FTC for false and misleading advertising, right? But Bruce, let me stop there, and we have about 10 minutes for questions, 5-10 minutes for questions.
Yeah, thanks very much, Peter. We had several participants write in about what is it that's going to happen when we do have rates drop, when rates are cut. Is that the only thing really that's preventing development transactions from going forward? What's your thought on that?
It's not the only thing. I mean, there is softness in the near-term market. There is some, but it's probably the major thing at this point. Because I'll take apartments, industrial, demand is pretty good. It's not that there's weakness because there's no demand. This is not like the economy has fallen apart and there's no demand. Right. There was a surge of supply. And on top of that, the development costs went up. So one of the things that will happen is you'll hear the cheer from anybody who's got floating rate debt, which includes almost all developers. But remember, there are other people with floating rate debt. Just think of a corporation, a manufacturer who secures their inventory and receivables, and they have a line of credit. Well, they're not getting any benefit from inflation right now. This is the distortion, right? They're getting no benefit from inflation occurring, but they're paying as if there is inflation on their borrowing on their line of credit. If there were inflation commensurate to the interest rate, you'd say, well, I pay it on my line of credit, I get it on my revenues, it's kind of a wash, right? You're not getting it on your revenue side. That's the issue. And it's very distortionary. When you hear people like me say it's distortionary, that's the distortion. And those happen. I think you'll see the long rate fall another 25 bips pretty quickly when the Fed finally cuts. You'll see auto consumption start nudging up a little bit, not on 25 bips, but as you get more than, there's no consumer of automobiles who's sitting there going, sweetheart, if the short-term rate goes down by 25 basis points, we can afford it. That's too precise. There may be an MBA student who's got a model like that, but that's not the normal consumer. It's when you start seeing the 50 basis points and the 75 basis points that matters to people.
Thank you. We also had several write in about, given that the US economy is less interest rate sensitive now because it's much more service based, is it as meaningful to look at yield curve inversion as a potential indicator of upcoming recession?
Yield curve inversion has never been a very good predictor of recession. In fact, we just lived through what now? Two years of that being shown to be the case. Remember 2 years ago, everybody said, oh, you know, the yield curve, it's inverted and we're going to get a recession and blah, blah, blah. You know, first of all, empirically, it has not been very accurate. So let's just start with that. The theoretic concept is one that says, well, you know, you get a yield curve inversion because of short-term outlook being very different than the long-term outlook. The short-term outlook is different, but it's all artificially created by the Fed, right? It's all artificially created. If you did not have a Fed, I'm not saying whether we should or shouldn't, if we didn't have a Fed and we simply let the short-term interest rate be determined the same way all other interest rates are determined, like the 10-year, right? The Fed's not setting the 10-year or the 12-year or the 14-year. If we simply had no interference from the government with inflation running where it's at, the short-term rate would be something like 3%. So that inversion is all caused by the Fed. Now you'd say, well, that distortion is going to crash the economy. It's not crashing the economy because we were so far below trend to start with. So it's slowing the economy, but it's not crashing the economy. Big difference. Big difference.
Thank you. You mentioned before that you estimated that we're roughly 2 to 3 years into a roughly 6 to 7 or 8 year recovery. Where do you think we are in terms of the real estate cycle?
Early. And by the way, this is true of a lot of cycles. You had that huge, remember that chart I showed you of the Federal Reserve where you had this huge excess demand. Well, apartments were one of the industries that would have been in that. Warehouses would have been in that. Okay, so you had this situation where this distortion occurred from the shutdown. Again, I'm not saying whether we should or shouldn't have shut down, but we did. And that created these, as the economy came back, these shortages. That created the spurt in prices, which created profits, which created a spurt in supply. That cycle is really just beginning of the spurt of supply occurring with pretty good demand. Pretty good demand. Now, office, not such pretty good demand, but the others, pretty good demand. You're still early on in that way. I think demand will continue to grow at a normal rate, not at 5% a year or 8%. Did you really think that inflation is going to be 1% or 2%? NOI is going to grow at 10%? Of course not. Of course, I mean, maybe for a property, but not in general. And so you get back to a much more normalized situation happening over the next few years.
Hey, great. Thanks so much. Unfortunately, we're not going to be able to get to all of the questions that came in over the course of the webinar, but I do want to make everyone aware that this webinar is a digest of what's presented in much greater detail in the Linneman letter, the quarterly subscription publication from Linneman Associates, and more information on that can be found at the Linneman Associates website, which is shown here. As a reminder, if you're registered, you will automatically receive an email link to the recording of the webinar in about an hour. Thank you again, Peter, for sharing your insights, and thank you to everyone who joined today, and we will see you back in early November.
Thank you. Have a great day, everyone.
Thank you.